So before we start this session, I'd like to quickly introduce the team that will be helping us with this discussion. My name is Bernard Obin Boateng. I'm a Microsoft MVP, Microsoft Certified Trainer, um, an advanced financial modeler. I also have the Financial Modeling and Valuation Analyst certification and Principal Consultant at Best Limited. I'm ably supported this afternoon by Ernest Abuaje, who is CA and also holds the CIMA certification, also an AFM, an advanced financial modeler, and also has the FMVA certification. Ernest works in strategy at Absa Bank. Then we have Ferdinand Atobra, who is a Microsoft certified trainer, an advanced financial modeler, also holds a financial modeling and valuation analyst certification, also works with Best Limited. We also have Diwinga Dohuta Amenonka, an advanced financial modeler, Microsoft Office specialist, works at Injaro Investments. And our lady in the team is Ms. Priscilla Ba, who is also an advanced financial modeler, a Microsoft certified data scientist, and works with Get Innovatized. So this is the team that will be walking us through our financial modeling discussion this afternoon. It's going to be very interactive. So if you have any questions, as I mentioned earlier, this is set up to be a webinar. You can raise your hand, we'll give you the mic. We'll call for questions, any inputs that you want to put in, please feel free. So we'll now start the process. So for starters, I think it is important we define what financial modeling is. And a financial model always has a real world business situation. So it comes from the need to understand real world business situations. That makes us create what we call a conceptual model. So example, if you are going to start a new business or a new project, or even as an existing organization, if you are going into a new project, it's very difficult to think through the variables of the project without putting it down or unpacking it. So from that real world business situation, you create what we call a conceptual model. Now, the reason you create a conceptual model is to help you break down the numbers. Okay, so when you break down the numbers, we typically use a spreadsheet, and Excel, Microsoft Excel has become synonymous with spreadsheets. So usually most financial models are created in Microsoft Excel. The reason is that if you look at the design of a spreadsheet, it helps us to really unpack every assumption or every variable or every input in our financial model, so we can question them. Okay, so we break it down through a spreadsheet and then we analyze. And then based on our analysis, we are able to get some insights, which will help us interpret and make valid decisions. So example, you now can be in a better position to decide whether you want to invest or not in a project. Okay, so that essentially is the schema for a financial model. It's a bit simplistic, but the idea is that you always start off with a real business situation or a financial situation. You start off to understand, making sure you've covered every variable assumption in there. Okay, and you create a conceptual model. You break it down using a spreadsheet, Microsoft Excel. It helps you analyze to gain insights. And then when you interpret these insights, you are now in a better position to make decisions, okay, to invest or not, or any other financial decision you want to make. So the key things here is that, one, a financial model is an abstract representation of a real world business situation, okay, or a real world financial situation. It usually involves math or numbers, and it is used to forecast business dynamics. A financial model is also driven by assumptions or historical data. So in the financial modeling world, we draw a line between greenfield projects and brownfield projects. So if you're a startup, you probably don't have any existing companies, or you don't have any financial data to use as base case to project. Okay, so you can just use base zero assumptions. Or if you're an existing company, you have some financial data, maybe the last 3 years financials. It's always good data you can use to project what's going to happen likely in the years ahead. Okay, so these are the key things that come to mind when we are trying to define a financial model. Mr. Waji, I don't know if you have any comments on this, and then we can take questions from our audience.
Okay, thank you, Ben. Well, like you said, this really helps, drill down your ideas and even forces you to think about your business in some sense. Because on top of your mind, you have a business idea or a situation, but if it's not organized in a manner that you can actually make sense out of, you might just go ahead, jump into the business, and realize later on that you are not successful, or you didn't actually look at something you were supposed to have. So in a sense, it forces you to think about the business, the possible numbers, the financials that can come through, even the pricing of your product, the volumes you want to sell, the economic conditions available, and what changes are likely to happen, right, as you step into the future. And if you are fortunate, you have already been in business, then that is also better. You have 3 years financials, or as many as you have, but 3 years, the better. As far back into the future may not be representative, but if you have that, you can also project from there. You know the seasonality of your business and the dynamics. Then that can help you think and plan for your business in spreadsheet terms, so that what the numbers are saying, whether the business is a good deal or not. That's in essence what we are saying. Can apply for projects, government projects, can apply for deals, right? And all parts of, strategic planning in numbers. Yeah, so Ben, I think that's what I can add to that as we move.
Great. So touching on why we use spreadsheets, the reason Microsoft Excel is used for financial modeling is by its design, it forces you to question some things that you may likely overlook. Okay, and we'll show you an example of a real world financial model, and you'll probably be able to now situate all the things that we've mentioned. Are there any questions on this? Please feel free, hit the button. And then if you have any comments as well, please feel free. With this out of the way, okay, so Emmanuel, please go ahead. Hi, Emmanuel, please unmute yourself.
Please, can you please differentiate between the budget and the financial model?
Okay, so good question. So essentially, a budget, it's a type of financial model, in the sense that a budget helps us plan. It checks all the boxes of the things that we've defined already. So if your goal to do a budget is to help you project what is likely to happen, okay, then a budget becomes an example of a financial model. I don't know if any member of the team has anything to add.
Yes, so Ben, clearly a budget is a type of a financial model, right? Because all of them are based on probably what has happened and projecting. Even if you don't have any information, you still need to budget. So it's a form of a financial model, but a budget is not equal to a financial model. You can say the financial model is the bigger umbrella, and a budget falls under that, right?
Emmanuel, I don't know whether that holds for you? Hi, Emmanuel.
Hello, I'm okay. Thank you very much.
Sure, welcome.
Yeah.
Okay, so with that, let's move on to now attempting to define what financial modeling is. We may not have to keep all this in our minds, but the idea is, if you look at the yellow words, the fact that one, it involves numbers, is a mathematical model. It can be reflecting historical, it can be reflecting current or projected value, okay, or financial performance of a company, a stock, a project, an investment, or any financial asset. In some cases, financial models are used to calculate the impact of different variables, such as interest rates or corporate growth rates on the value of an asset. So here, this is just to pick out the keywords from this definition. There are other definitions, but essentially, this is what financial modeling is about. Now, let's talk about the part of a financial model. Again, it depends on the task, your deadline, and information available. But you can classify them generally into 3 segments. The first one are your inputs. Okay, so these are the constant numbers that you put in. And then the second segment is your calculations. Okay, and then from your calculations, you derive your output. So if you think of any financial model, these are the 3 broad areas: your inputs, your calculations, and your outputs. Now, when we take inputs, we actually talk about assumptions. Okay, so you always start your financial model with your assumptions. If it is an existing company, you have your historical data to give you a baseline to sort of estimate your assumptions. Okay, now, after you've given your assumptions, there's also the calculations part. In financial modeling, we approach it from a very organized way. So we call these schedules. Okay, so along each major block, you create schedules. So we have the revenue schedule, the cost schedule, the tax schedule, working capital, taxation, and all those things, debt. Okay, and then from the schedules, you link them up to your financials. So in the journey, your 3 financial statements, that's the income statement, your balance sheet, and your cash flow, become the primary data which you can use, okay, to get your results. So results, you are talking about valuation, or from the 3 financial statements, you can now go on and do a break-even analysis. Or if you like, you can run scenarios on the financials. And then if you like, you can also run sensitivity analysis on the financials. Okay, we'll go into all these, but the learning here is that if you think of any financial model at a very high level, you can break it down into inputs, calculations, and outputs. I'd like to invite Iringa to see if you have any comments on this.
Thank you, Bernard. So one thing I can add is a financial model is a decision-making tool, like Bernard said, but it's also a communication tool. So typically when you build a model, you share it with users. It can be internal or external users. And so there is something more like an investor language that financial modelers speak. And so when you look here, these 3 key parts of the financial model that you have, the input, the calculation, the output, they have a color scheme. And so when you take a typical financial model, you see some numbers in blue, some numbers in black, and some in green. Your blue numbers are assumptions or inputs. They are numbers that can be changed. So essentially, you are telling the user that these numbers, you can tamper with them. And anything in black is a calculation. So it's driven by a formula. Before it's changed, then really the understanding on the rationale behind that formula should be analyzed. And then when you have a link from a different sheet, that's in green. So you see green, black, or blue, and this is what they serve. This is what I wanted to add when it comes to this part of the financial model.
Okay, so when we show you the second part where we go into a real model, we can now relate to what Deringa is talking about, that even in we have a special color code for some of these segments, and there's a reason for that. So the learning here is that for a financial model, the highlights will be the input section, the calculation section, and the output section. Now, these are the uses of a financial model. You can use it to raise capital, make business acquisition, grow businesses organically, open new stores. When you're entering new markets, you need a financial model for that. Selling or divesting assets and business units, budgeting and forecasting. So, Emmanuel, this is the question you asked. That is a type of a financial model. Capital allocation, and also in most cases, we use it for valuation. Okay, so these are the uses. Now, for a very typical financial modeler, these are the rules you need to go with. One, you should not hard code. Because your model is supposed to be flexible as much as possible, when you're doing your calculations, don't make it transparent so that people are able to audit and then see the logic you use in building your models. Okay, every cell is linked to the assumptions, which is the input we mentioned earlier, and these assumptions drive the financial model. There's also consistent labeling. Okay, and when you are doing a financial model, truth is that you cannot think of every variable or every assumption. So we have this rule called sufficiency principle, that you are just using enough assumptions to get close to the real world business situation. Okay, so we always fit ourselves between a simple model and a very complex model. If you overdo it, essentially it will not be very easy to understand. But if you make it too simplistic too, you may not be covering every aspect. Okay, so the sufficiency principle will make sure that you are always giving us enough to make a decision. When it comes to financial models, it depends on the industry, but usually the average timeline is 3 years or 5 years, which is the standard. And for most agric projects, you can look at 10 years, because obviously if you are waiting to harvest, 10 years is a good time to get some ROI from your crops. Okay, so it depends on the industry here. And then there's also a clear structure and design when it comes to your financial models. Ferdinand, I don't know whether you have any comments on this, and we can take some questions. Hi, Ferdy.
Yes, Ben, so thank you. So here, as Ben mentioned, what we are going to see when we do the practical, we'll see that we have a clear layout for the structure of the design. And Deringa also mentioned the color coding. It's very important because financial models are communication tools. So the color coding helps, every modeler to understand what, everything in the cell is doing. Either is a formula from another worksheet, or maybe it's a calculation, and so on and so forth. And very important is your assumption for your models. Okay, it shouldn't be too complex, as Bernard mentioned. It shouldn't be too complex, and you just need to to model based on your understanding and whatever variables that you think are very necessary for the model. You don't put everything because you want to have all the assumption in your work, in your model. So we just use those assumptions that really speak to whatever that you are doing at the moment. And also, when it comes to timelines, basically we'll go just for a 5 to 10 years model, but you can go beyond if you deem necessary. And consistent labeling and a structure. And I will also know about what hard coding is when we start the modeling later.
Okay, thank you, Freddie. So we'll show you a real case. In fact, the goal this afternoon will be to walk through a real solution, and you would appreciate some of the things that we've raised so far. Okay. Are there any questions at this point? I see some people have joined in now. Abraham, Prince, Andy, Jifa. If you have any questions, please raise your hand with the button and we'll allow you to talk. If you have any comments as well, please feel free and we would also accept your comments. Okay. Now, there's a rule called the FAST rule for every financial model. The first one is that your financial model should be flexible enough. Okay. The fact that you run scenarios on your model means you don't take a cast in stone approach. So you should be able to build a model that can be extended from 3 to 5 years or for 5 years to 10 years. A model that allows you to change inflation rates if you have to. A model that allows you to change your assumptions if you have to. So F is for flexibility. A is for appropriate. You should not overbuild or clutter with unnecessary detail. Okay. In any case, the model is a representation of a real world situation, not the real world itself. So it should just be appropriate so that it is user friendly. For somebody who doesn't even understand numbers, when you present a model, he should be able to take insights from it. S is for structured. It has to be structured. Thing is that when numbers are in black and white, it's very difficult. So if you don't structure it well, it becomes very heavy for the user. Okay, so you need a consistent approach to structure workbooks, worksheets, and formulas, especially when you are building, and even for the user who is going to use it. And then the last one is T, it should be transparent. People should be able to audit and then go through your thinking. Whatever approach you used, okay, should be transparent enough for anybody to raise questions. Okay, so there are a group of people who actually are promoting these features. You can find them online. So the first principle is a very good way to approach all your financial models. Again, when we go to our second segment, you can relate to this. What are the skills required to be a good financial modeler? There are 4 key skills. The first one is because most financial models are done in Excel, you need to be not really very, but should be able to get your way around a typical spreadsheet. Okay, so is important. You also need industry knowledge. So if you are tasked to build a financial model for a hospital, of course, even if you are not in the industry, you should be able to consult and then get the key assumptions right. Okay, so you need some industry knowledge. Accounting and finance is key. So I know we are speaking to people who are very comfortable in this area. So if your accounting and finance is good, then you are in a good place. Really, it's sufficient accounting and finance is good, not to IFRS 9 levels, but if you have that, it's a plus, because essentially you are supposed to balance the model. And to balance the model, you need an understanding of how the 3 financial statements react or connect to each other. And that's why good accounting or finance skill is also important. The 4th pillar is you need some aesthetic or design skills, because you may be communicating right, but the way you apply your colors and the way you structure your model in itself can be a put off. So you need to be able to learn how to even use the right fonts, the right design, the right arrangement, and all that. There could be more, but from my experience, these are the 4 pillars that we think are critical to become a good financial modeler. Priscilla, any thoughts on this? And we go for questions.
Yes, so I would like to stress more on the industry knowledge because I feel like sometimes it's a bit overlooked. And really understanding, really having a good industry knowledge is also understanding the context in which you are building your model and understanding even the problem at hand or the business case in which you are building your model, you need to understand that for the particular company that you're probably building your model for, there may be some particular metrics that they are most interested in that are probably not the average models that maybe the average metrics that maybe models look for. So although you might have a general understanding of how models work, and you need to really, really understand also from the company point of view, what exactly interests them, what kind of information do they need to make whatever decisions that they are making based on their models, and make sure that you present that information very clearly and very emphatically for them to really benefit from the model that you are building.
Fantastic. So at this point, we've spoken a lot about the ins and outs of financial modeling, what a good financial modeler needs, the skills, how a financial model should look like. We've also defined what a financial model is. The key words in there is that it's an abstract representation of a real world business or financial situation. It includes numbers. It's used to forecast business dynamics and all that. Are there any questions, please? If you have any comments, questions, please hit the button and then let's have a chat. In the subsequent segment, we'll do the practical part where we go through a real world financial model. But this is just to introduce us to the concept. Okay. So with this, maybe you are interested in certification or you want the knowledge. We have a list of bodies that offer financial modeling. The very popular ones are the Financial Modeling Institute and the Corporate Finance Institute. We as a team are aligned with the Financial Modeling Institute. Website is fminstitute.com or www.fminstitute.com. They are the body that offers global certification in financial modeling. So they have 3 levels: the Advanced Financial Modeler certification, the Chartered Financial Modeler certification, and then the Master Financial Modeler certification. So as approved training providers for them in Ghana, we use their body of knowledge to teach. And then we've so far trained over 30 advanced financial modelers and counting. We started work on making these advanced financial modelers also gain the Chartered Financial Modeler certification. There's also the Corporate Finance Institute. This is online. You have all your videos online. The certification is the FMVA, Financial Modeling and Valuation Analyst. Also very good self-learning. So the others are also listed here. If you are interested, you can go in and also find out details on the things that they offer. So I guess at this point, we can go into our Excel. I'm sure most of you have been waiting for the Excel part. So before we even go into the case study, we've designed this building block. Now, if you look at the areas in column B, okay, these are generally the 8 building blocks that if you're a financial modeler, you should use as a guide to approach your financial model. Okay, so there are 8 of these. The first one is general and model controls. Look at this as settings of your model. So how long was the timeline? 3, 5, 10 years. Okay. How you capture inflation, how your numbers will be expressed, whether in millions or thousands. These ones, they are set in such a way that you can always come back and tweak them easily without really overstretching the model. Okay, so the circuit breaker also allows you to control a calculation that's actually iterates. So I'll break it down in English, that sometimes when you do formulas, you can get to a point where the formula refers to itself. In a typical financial model, that is required. How you set it up are all part of the general model controls. So that's the first block. After you think about your settings, the next thing you think about is how would you project your revenue or sales? Of course, every business generates revenue. unless you're an NGO or church. Even churches provide a top line. So you think about how you generate or project your revenue or sales. Now, as a revenue or sales, in a revenue or sales block, you are basically thinking about the price or the volume, okay, of the business, okay, and then how this price and volume will grow. So if you take this block, that's the revenue or sales block, it typically would lead to the revenue or sales line in your income statement. So this is how this schema is designed. The lines that will feed the income statement, we have it in orange. The blocks that will feed the balance sheet, we have it in green. And then the blocks that will feed the cash flow, we have it in blue. So from these 8 blocks, the final result of the calculation will feed any of our 3 financial statements. And that's how we are thinking through this. Okay, so apart from the settings, all the 7 would have an output that will feed the income statement, the balance sheet, or the cash flow. But if you unpack it or you roll it back, this is where we begin. We think about revenue or sales in terms of price and volume, and then how it grows or how it changes. The next block is the operating cost block. So here we talk about the variable costs, the fixed costs, and then the SG&A. Again, this also grows by cost inflation. In the end, your final calculation should feed your cost of sales, SG&A expenses in the income statement. The next block is your long-term assets. Okay, so here the subcategories are: you forecast your capital expenditure, you also take your asset dispositions into consideration, and then you also consider your depreciation method, whether you are using a straight line or any other depreciation method. In fact, in most financial models, we use a straight line. But here, you also need to consider the useful life for existing assets and the CapEx that you are bringing in. When you are done with this calculation, it feeds the depreciation line in your income statement, okay? And then the net PPE, which is also another derivative, feeds the balance sheet, okay? Your CapEx and your asset disposition and your depreciation are also indirect outcomes for your cash flow. Okay, so that is the 4th block. Then you move on to the working capital. So here we are trying to project our working capital, and we use our revenue and cost of sales as basis. And then we use our days, accounts receivable days, inventory, accounts payable, to help us project a ratio that would give us these lines: our accounts receivable, inventory, accounts payable, changes in working capital. When you are done with this calculation, you are basically calculating to feed the balance sheet and the cash flow. So that is the working capital. And then we have the taxation block. So here you consider the tax rates in there and then timing differences. So your timing differences will lead to either a deferred tax asset or a liability. And here too, you are feeding your current taxes line in the income statement, your deferred income taxes line, and then your deferred tax assets in the balance sheet or cash flow. And then the next block is long-term financing and debt. So here, the subcategories are fixed rate term debt and variable rate term debt. So whatever assumptions you have concerning these 2 subcategories, in the end, these are the lines that you are calculating for: net interest expense for the income statement, variable rates, repayment for the balance sheet and cash flow, your cash, which is also very important, or vice versa, your revolver. Okay, look at that as an overdraft in some cases. And then that also feeds the cash flow. And then finally, you also have the equity block. So this one, you are thinking about the dividend yield, whether you are issuing shares or you are repurchasing shares. So that would eventually feed the dividend lines in your income statement, preferred shares lines in the balance sheet, and then the cash flow as well. Mr. Abuaje, do you have any comments on this?
Thank you, Ben. I do. I I think this is very, very important because it helps you to actually think about any operation in such a manner, right? And as you start to even consider your business idea or the model for which you are building, you kind of systematize it in your mind that if you are thinking about, okay, what drivers should I consider for maybe my revenue or sales? What are the drivers I should consider for operating cost and all the others, right? It kind of forces you to think in a certain organized way, which will help us, achieve the sufficiency principle we're talking about. I mean, kind of detailed enough to consider all the useful variables you have in there. But that said, I think let me add that not all models will run through all these 7 plus the settings, in its entirety. There are some models that you only perform, which you are interested in, maybe some debt computations or debt switches or some other sweeps. So in such a case, your interest, right, in that model, you may not start with revenue, start with whatever, but you are going for a loan, you want to check the loan facility and your ability to pay and all those stuff. So your interest will probably be only your ability to model something around long-term debt financing or debt financing in even debt structuring deals in investment banking, right, and in other decision making. So we have these blocks, kind of helping you go in that direction, but it's not as if every model is necessary to run through them. Depending on your interest, if you are only looking for something on cost or you are trying to check something on, you can only do that bit and it's your model, right? So that's all that I want to add to that. Thank you.
Fantastic. So I agree with you. It's not every time you use all these 8 blocks. It's supposed to be a guide to help you systematize your thinking. So if you take any financial model, at least you find some of these blocks, okay, in there. But in the end, because you are going to generate the primary data for assessment or decision making, which is your 3 financial statements, this guide will help you unpack or work backwards, okay, on how you approach it. So it is this model we are going to use, and to make it relevant or help you understand how we apply these blocks, we are going to take a typical question. And this is one of the past questions of the Financial Modeling Institute, the Advanced Financial Modeler Certification. We would go through the question. In fact, even though it's academic, the principles also apply to real world situations. So in the end, you should get a general idea of the approach, the kind of formatting, the kind of calculations, how we lay out the sheet, okay, how we link it to the financials, and eventually how we even create our summary page for the final decision making. But before we go into that, I think it would be good to hear from you. If you have any questions, please let us know. It's a webinar setting, so just raise your hand. We'll be giving the mic and we can hear your questions and answers. Your questions and suggestions, I must say. Okay, Emmanuel, please unmute yourself.
Yes, sir. From your experience, what level of knowledge in terms of Excel will make one good at doing financial modeling?
Okay, Priscilla, would you like to take that?
Yes, of course. So for financial modeling, you actually don't really need much of the knowledge of complicated Excel formulas for this, and Usually, actually, the most common formula that you're going to use is sum, just adding some numbers together. But outside the sum formula, I think one other formula that you would probably use is the if formula, a simple if formula to probably create various conditions to present some figures. And one other formula that you might probably need is the index match, or a kind of lookup formula to help you find some particular value. But apart from that, it's not really much. And these are formulas or formulas and functions that you could probably learn within a very short period of time. Comparing it to other functionalities that we have in Excel, it's not really much. I think the most of the times what you need to mostly learn and will probably take you time to learn in Excel is how to use various shortcut keys to make sure that you're not spending too much time on your model, because building models, usually there are things that you repeat, there are some actions and commands that you repeat, and some of these might take a long time to do. But if you have knowledge of some of these shortcut keys that you can use to probably duplicate some sheets, probably duplicate some cells and some actions, it makes it easier for you to work faster. So I think learning those are probably what takes time, because for you to get used to them, it means that you have to practice more and build more with the model to get used to these keys and these shortcut keys. So those are what really takes time. And it's not really about expert level, it's about how much time that you can dedicate to building the models to get that skill. But apart from that, the formulas that we use in our financial model are not that advanced and should take you a very short time to learn. Don't know if that will convince you.
Emmanuel, are you convinced?
Yeah, that is quite comforting because if you look at the way these presentations are done, one would think that it requires a lot of Excel or spreadsheet mastering. So it's quite comforting, and thank you very much.
Sure. And I agree with Priscilla. It can be intimidating, but in truth, and from our experience, you don't need to know Excel inside out. If you look at this solution that we are showing you on the screen, the typical formulas in here are sum, if, index, and match, okay, and a bit of aesthetics, okay, how to lay out your sheet, how to use shortcuts, and all those things. In truth is, there are advanced models that will probably require other Excel skills. Like if you have a situation where you need to do a Monte Carlo simulation for some of the advanced models, that will come in handy. But generally, for most of the models that we build, you don't need very lengthy formulas to get your logic across. Okay, so that is to comfort you, but you need to practice, because if you look at the Financial Modeling Institute exam, you are supposed to deliver this full solution in 4 hours. Okay, so you have your cover page, your summary page, your assumptions page, your scenarios. Remember, we mentioned that you need to make your model flexible. You don't present only one angle of a solution. What if inflation goes down? What if inflation goes up? Okay, what if sales prices are affected? The user should be able to interact with the model. Okay, so you need to provide scenarios, pick the key indicators that may affect your model, and then flex them. That's how we call it. Okay, and then you come in and build your schedules along the 7 segments that I mentioned earlier. So this is the revenue model. This is the operating cost schedule. This is a long-term assets schedule. This is your working capital schedule, your taxation schedule, debt and financing, equity, and that. After you've done the calculations for these segments, then you sweep them into your financials. Okay, so typically these are your 3 financial statements: your income statement, your cash flow, and then your balance sheet. And of course, your model has to balance. Your model has to balance. Okay, before we even go on to do any summary assessment or any scenario sensitivity analysis. Okay, so let's go to the question, and we'll share this, but because of time, we would like to visually walk you through. So this is the real world situation, even though it's academic. This is for an existing company called Henderson Manufacturing. They are into storage tanks. They manufacture storage tanks, and they have an existing historical. Okay, so normally for these existing companies, or for any kind of model you are looking at, you take the 3 years or 5 years historical, and then based on that, you project. Okay, so I'm not going to bore you with the questions, but the idea is that these have been given as notes. So if in the real world you're a consultant and you're engaging any client, you typically will take notes, okay, from the client to be able to do accurate projections. And that is what this question has been set out to do, give you some indicators to help you project. Okay, so we'll now walk through the typical solution and where we even start off. Now, if you look at this model, it has a cover page. So the date that you created it, the title of the project, and then usually we put in a timeline. Okay, if it's 5 years, you indicate that for documentation purposes. And then this is your output. Now, typically when you model, this is where you focus on when you are presenting, because you've pulled all the black and white to this point to now flex them or create different scenarios. So you can give the client an idea that if you run a best case, this is what will happen. If you run a worst case, this is what is going to happen. In fact, from experience, most clients or users are not typically interested in how you modeled it, but in the results. So what should we do? Should we buy or we should check out? Or timing, when should we buy it? Or if you go in at all, what should we consider? Okay, so that will give you an idea on how to focus on the summary page. Freddy, you have something to add to this?
Okay, I wanted just to add to what Priscilla was saying about the formulas.
Okay.
But Ben has already dealt with that. But just to also say, we also mentioned the structure, the layout structure, and that will also inform the type of formulas or function that you have to use. So based on this structure, the model makes it very easy to use simple formulas to to build your model. So just one key that we have to take is your layout must be in a certain structure so that you don't struggle with what formula to use. Because if your model is not structured in certain ways, you have to go to pick some functions and combine it with others. So basically you see from what we are coming to do next, okay, the practical aspects, like the formulas are not too complicated. Okay, very short formulas, index and match, dividing this by that and all those kind of things. So just to add to this, so your structure, your layouts, I just want to
Okay.
that.
Yes, so the layout is very important. And if you are in class with us, we always begin a financial model with a blank sheet. Okay, so this is a typical model. And from this blank sheet, you need to carve it out or structure it in such a way that makes it easy for you to model. Because if you go to every page and you have to redesign or change the settings, it's going to slow you down. Okay, so in the process, we create something like a template. So if you look at this layout, you see that we have like this template here. Okay, margins sets here. We have our banner that shows the title, and then the scenario we are running, and then the page or the worksheet that we are currently on. Okay, it also has our timeline that gives us our actuals. So usually if you have your actual, this is where you place it, and then you do your estimate or your forecast in the subsequent columns. For easy navigation, we try to hide columns that you are not going to use, because, are we live?
Yes, we're live.
Okay, because in most of your calculations, you'll be copying right. You need to make sure you're always at the end of your active column, and don't use ones, you can hide them. Okay, so after creating a blank worksheet, typically this is how you approach it. And one skill of a good financial modeler is, as much as possible, you should wean yourself off the mouse. Okay, I mean, not saying the mouse is not good, but a good financial modeler uses all 10 fingers to do everything. Okay, so example, if I want to set this column margin to 2, okay, my shortcut control spacebar highlights this. I don't even have to highlight this. I can stand in here, and then we use some shortcut keys called the Alt keys. So in Excel, you realize when you hit the Alt key, you get these labels on your screen. Okay, it's a very good guide, okay, to activate some of the buttons on this ribbon. Okay, so if I'm using the Alt key, an example, I want to format a column, I use Alt H for home, okay, O for format, and then W to set my column width. And this, I'm setting it to 2. So if I do this and I enter, you realize that I've now set my margin. I can do same for column B, which normally takes the labels. Okay, so if I'm here, Alt HOW, I put this at 50. And then in a typical model, if it's 5 years, you don't normally go beyond column P. So I set this one to 10. Now, I was talking about the fact that if these columns are not going to be used, it's helpful, especially if you want to move quickly, to hide them. So you can select them, and then you hide them using Control 0, Control close bracket. So that's how you approach it. If you want to make your last visible column show, okay, you can just go like that, Alt WG, and then you have something like this. So in the end, this width that you've designed is now going to be used throughout all your model. Okay, you can name it. So for example, this is my cover sheet, Alt HOW, and I'll cover this. Okay, put in your cover page, any details that you have here, and then take off your grid lines if you want. So with this, you can now duplicate it. Okay, so from what you did in the first page, you can now duplicate it and use that to create your assumptions page. Okay, so that when you come here, you don't have to start the process again. You are just using the same design that you used earlier in subsequent pages. So for assumption page and beyond, because it's going to carry information, we normally use a banner. Okay, so we use a banner to put in, example, the title, the scenario that we are running. Okay. Okay, and whatever details that we have here. And then you can dedicate this page or this range to your timeline. Okay, so when you set this now, this becomes your template that you can carry on. So this now becomes your scenarios page. Okay, and then you make the changes, and then you move on, you create another page, your schedules page, and all that. By doing it like this, you save some time. Okay, so that is the thinking behind making sure you are consistent with your worksheets layout. Truth is that there are ways you can build your financial model. In some financial models, you can build all of them on one sheet. So we call that the tower approach. So you have everything from assumptions all in one sheet. It's allowed. Okay. Or you can go the tabular approach, which is what I'm doing here, where you put every segment in different tabs. Whatever works for you, you just need to approach it from a very consistent way. After doing your layout as I've displayed, the next thing is to put in your assumptions. Now, your assumptions would have to be organized, okay, along the blocks that we mentioned earlier. So you realize that the first block was the settings or the model controls. Now you have these settings here as subheaders. So your scenarios block is here. So this is where you change what kind of scenario you want to run. So whether you want to run base, best, or worst case. Okay, so the options are here and these are linked. And then you also have your start date. You remember the F in the FAST principle says your model should be flexible. Okay, if it's flexible, it means I should be able to change the date or the timeline or even extend it. Okay, so that is why we put in these dates which feed your timeline. So you realize that this start date here is dependent on this. If I change it to 2016, okay, it should update and then carry on. That's what we mean by flexibility. Now, these colors that you see here is not random. There's a color code, at least generally for financial modeling. The ones that you see are in blue are inputs that the user can change. So anything that you see here that is in deep blue, okay, it means you can change it, okay? So typically the assumptions page has a lot of these blues. Okay, so anything you see here, it means you can change. So we have the model controls, and then after we have our revenue assumptions. So in our revenue assumptions, again, we are thinking about it in terms of price and volume. This consistent subheaders that you have here, okay, we've made it consistent using what we call cell styles. In a typical financial model, you don't do this every time, but you set it in Excel's memory so that anytime you come to a point where you want to introduce a header or a subheader, you can activate it from here. You realize that I have my assumptions label also here. So this is how I capture my assumptions. I don't have to do it every time. I've set it as a custom cell style. I can always come here and then use it for my assumptions. So if you see a consistent blue input or a consistent blue subheader or header, that is how it was created. Okay, so I have my operating cost and the assumptions here. I also have my long-term assets and the assumptions here, my working capital and all that here. Now, if you see a number that is green, it means it's linked to another sheet. So already I've mentioned blue. Blue are input cells. The user can change it. But if you see green, typically, it means it is linked to another sheet in the financial model. Again, these are not cast in stone, but these are generally accepted color codes in financial modeling. So this green you see here is not random. It's serving a purpose. It means that when I was forecasting my assumptions for my working capital, I referenced my revenue, which is in another sheet somewhere. And that is why this is in green. Okay. The third color code you use in your financial model is black. Black represent calculations. So when you hand over your model, it means the person should not tamper with the black calculations because they are dependent on the blue ones. So if you want to make any changes, then you better go to the blue and change them, and the blacks will respond accordingly. So you realize that even at this stage, just setting up your assumptions, there's a certain approach to make you find your model easy to work with, or even your user also find your model transparent. Okay, you don't hide any calculations anywhere so that people can't even trace or audit it. Okay, everything starts from the assumptions page, and that's what you have here. So that is the assumptions page, and is the beginning of every financial model. If you are doing a tower approach where everything sits on one page, typically the assumptions will now be the first part. Okay, and then you can build on from here. Are there any questions, please, before we go on to the scenarios page, based on what we've discussed so far? I see a hand from Abraham.
Hello all. Mr. Obey, I'm just following the structure that you are presenting here. I'm just following it in a perception that I'm trying to get this linked up to the question that you have brought up. I'm looking at the actuals on the top there, that is period stats, that's the assumption side. And I'm seeing forecasting. But I see forecast for 1, 2, 3, 4, 5. That is the 5 years. But we're using it to match an actual assumptions on 3 years. So I'm just trying to link it to, is it something that the question brought this up or something like that?
Okay, fantastic observation. Doringa, would you like to take that? Why do we have 3 here? And why do we have these here? Is it something that the question asked us to do, or so can you please take that? You can share your screen if you have to.
That's fine. So from your screen. So in this very context, this is what the question asked. So typically, I'm given
your mic.
Hello, can you hear me?
Hello.
Ben.
Yes, it's clear now. Please go ahead.
Okay. So I was saying that in this context, this is what the question actually required. So we are given 3 years of historical data, and then we're using this per the request to forecast for 5 years. But in typical real life modeling, we believe that 3 years historical data is enough to have a fair idea of the financial performance of a company. And based on that, we think is enough to forecast or to project for the next 5 years. Again, if you have more than 3 years, say 5 years data, it's okay. But typically 3 years is assumed to be sufficient data to forecast for 5 or more years.
Okay. So to answer, I think that's a valid question, answer. In fact, the question says we have 3 years historical. So maybe it's good you brought this up. Usually you are given the actuals and then this now becomes your forecast zone. So just as the Doringa said, it's in line with the question. I don't know if that answers your question, please. Please give us feedback.
Hello, please, can you hear me, please?
Yes, we can hear you.
Okay, I'm very okay with the answer, but I'm just projecting something. In the cases where, for instance, 2020 happened to be a slum year for almost all companies, when you're using 3 years actual and 2020 comes in, it means that year may sync up a lot of data within the analysis that you are doing. And also, I'm just being a devil's advocate here. For instance, on the lifespan of a company, where maybe from the growth stages, you have moved to maybe trying to hit the apex of the, I don't know, that is on when you're looking at the lifespan of companies. Assuming you are in the upper limits before the curve falls to the bad side of the company. So you are using the 3 years or 4 years in the heydays of the company. Maybe the numbers may be putting out bright numbers, but maybe the company is actually in the declining year. But since it is generally accepted, I'm just looking at maybe some of the issues that may come up with the 3 years that we may use.
Yes, go ahead.
Yeah, so again, that's a very good observation. But you see, at the beginning of this, Bernard was explaining one key thing: industry knowledge or industry understanding. Typically, when you're building a real life model for a company, you want to understand the industry, the company reality, right? So like you said, there can be an outlier. There can be a year where they did extremely well or poor for external or internal reasons. Like COVID is something unexpected, and then most companies took a hit, maybe. And that's something that might not happen next year. And so when you do this industry analysis to understand key drivers behind past performance, and then you read more about the industry to know the direction this industry is heading the next 3, 4, 5 years, then your assumptions can be justified. Usually when you have a financial model and you share this with someone to review, they will sanity check your assumptions. And so when they are questioning your assumptions, you have to justify why you think inflation or growth rate has to be 20% instead of 15%. And because you think they are in the growth stage, and then in the next 2 years, they'll move into a maturity stage, you don't expect the growth rate to be 20%, but rather 15%. So industry knowledge or understanding can actually help you to contextualize your model. I don't know if that answers your question.
I'm very okay with it now. So and now I'm just trying to follow it in terms of the question wise. And now I think it now sets it clearly for the side where we had inflation, interest rate, and the rest. It now brings it clearly out for me. Thank you very much.
Fantastic. So Abi, the parts that speaks to this layout, why we have 3 actuals and 5 financial forecasts, is that normally in this exam, you are provided 3 years of historical financial statement. Let me see if I can display how it looks like. Good. So when you go into the question, they will give you this. They'll give you this. And these are actual financial statements. So we have 2015, 2016, and 2017. This one you didn't model. This has happened in the past. Okay. So your goal is to use this. Again, the winger said it is not cast in stone. It's not, you have to sanity check it. Okay. And it's just a base. So you use this as base to now go and do your 5. Okay, so that is where this is coming from. And if you come to the model, you realize that in the final output, the financials, we've sort of duplicated. So what you saw earlier is what is here. Okay, so what you saw earlier is what is here. So those 3 actuals are here in blue. You remember I mentioned that the ones that are given or the ones that you didn't model are always in blue.
Oh, okay. So just to chip in, since this one is coming from somewhere, wouldn't it be a green color referenced?
Okay, so I get it. It will not be, so the green actually is when you have referenced a part of the existing model. This one is, okay. So like if I come here, let me give you this green, which was under working capital. So you see this green?
Yes.
Okay. I was in answering this, you are forecasting your working capital days, your account receivable days, and then you are using revenue and cost of sales as basis. Okay. So in the assumptions, you are just letting the user know that I referenced this 213 from somewhere in the financials. Okay, so it's pointing to this 213.50 in the model. So you realize that because this 213 exists somewhere in the worksheet, I color code it for the user to know that there's a certain connection. Go there and check. The difference between this and this one is that for this one, we had no control. They gave it to us, their input.
Okay.
You get it? Their inputs, they gave it to us, and then there isn't anything we can do about it. So the blue represents input, green represents a link to another sheet in the model, and then the black represents your calculations.
Understood.
Fantastic. So if you look at the question, they say you have been provided with 3 years of annual historical financial statements for Henderson, which we just saw. The most recent of these 3 is 2017.
Okay.
Your task is to build an integrated annual model for the company for the next 5 years. So this is the part that you saw, forecast.
Okay.
Using the historical data and the following assumptions. Okay. So with this background, it gives us an idea to set out our timeline this way. Our historical 1, 2, 3 ending 2017, and then our 5 years forecast starting 18 to 2022.
Okay.
Right. So after reading this segment, then they also give you assumptions for your sales or your revenue.
All right.
And I was saying that because this is an academic setting, you can bring it home this way, that if this was not an exam, this question you're looking at is probably your notes as a consultant when you go and visit the client. Okay. So for every block, example, sales, if you look at the blocks that I mentioned, apart from the settings, there were 7.
Exactly.
Yes. So even the question has been given to you in these blocks.
That blocks. Okay.
So sales, 1 block. Operating cost, every note on operating cost is another block. Capex and depreciation, another block. Working capital, another block. So all the notes that you need to model each block have been given to you in the question. Okay. So take an example. Let's take the debt block.
Yes.
It says the senior secured term debt and revolver pay an interest at a fixed rate of 6%.
Yes.
Excess cash earns 1%.
Exactly.
Amortization, So as a good financial modeler, what you need to do is when you are listing your assumptions, you come to the block that speaks to this.
Exactly.
Okay. And then you lay out the key numbers. So all the things that I just read have been laid out under the debt and financing block. So remember, this is my rate, 6%.
6%.
My repayments are 25. My revolver, okay, attracts a 6%. My cash earns 1%. And all these are nicely set up in blue.
Yes.
And you use this to approach your financial model nicely. So that's how we're approaching this.
All right. Okay. Thank you very much.
Sure. Welcome. And I appreciate the feedback. Are there any more questions, please? Okay. So as we go, you can note down your questions and then ask them. And I think it will help in the learning. So after you lay out your assumptions, your page looks like this. And you now go to your scenarios. Now, in the scenarios page, we use indicators that we think can have an impact on our model. We are not presenting a one view case of our model. We allow the user to determine what will happen if inflation or any other thing happens here. So Priscilla will walk us through typically how we build our scenarios page and how we even approach it. Okay, because of time, she's probably going to demo just some few things that you need to know, and then you can take the lessons. So Priscilla, over to you.
All right, Bernard. Let me share my screen quickly.
Okay.
And then we can get it started.
So while Priscilla is sharing her screen, if you have any questions, you can put it in the chat. There's also a Q&A.
Okay, so Bernard has already mentioned, I think, generally the idea behind scenarios, this is making sure that your assumptions are not cast in stone and they are flexible enough to account for future uncertainties. Because as an analyst, you might probably have all the information that you need to build your model, but because building models is basically forecasting into the future, there are still some elements that would probably not happen as you would want it. So rebuilding scenarios is just basically capturing these uncertainties in more quantifiable, measurable terms, of course, based on some informed decisions, of course. So as Bernard mentioned, when we are building our scenarios, what effectively we are doing is taking into consideration those items in our model that we think are more volatile and their changing can greatly affect our model. For a three statement model, one of the most important things that you want to look out for in a three statement model is probably your cash flows. So in your cash flows, there are two main items that can greatly affect your cash flows are basically your revenue and then your cost. So usually when we are building scenarios, we usually focus on items that affect revenue and cost directly. So if we come to our assumptions page here and under our revenue block, usually one thing that would probably affect your revenue is inflation. Sorry, inflation is more likely to affect cost, of course, cost inflation. So that is most likely to affect your cost is inflation. But under revenue, one major part of revenue, one major metric that can affect revenue is your sales prices. So how much are you selling your goods for? And then also your volume. If you have an initial volume capacity in the future, how is this volume going to grow in the future? So these three metrics greatly affect your revenue and your cost and hence your cash flow. But as we said, a lot of these things you have to put into context. So whatever is important or whatever you feel affects the model most depends on the use case that you are working on and the industry that you are in and the company that you are building for. But for this scenario, we will be focusing on inflation, prices, and volume growth. So we have given these indicators or these kind of keys to help us identify that if we use the figure 1, we want inflation. If we use number 2, we want sales prices. If we use number 3, we want to talk about volume growth. So when you come to your scenarios page, typically you would have already have this timeline, this block that we have here from the other pages. So this would be there. But if you come to your scenarios page, you're going to have this clean slate for you to start. So just going to delete this that we have already done here so that we'll see how best we can get these kind of metrics, best worst case metrics that we have here from scratch. So when you come in here, usually the first thing that you want to do is to bring in the line item that you want to flex, the line item that you want to consider those scenario cases for. And if we come to our assumptions, the first line, that line item would have been, our first line item that based on the indicator that we've given it would have been inflation. So typically you would have probably want to come in here and do inflation. But we've already mentioned that for modeling, we want to ensure that our model is flexible enough so that if we decide that our first line item should no longer be inflation, you wouldn't want to come in here and probably type it, but you want it to be flexible enough that you can change its indicators and then the line item that you want to. So instead of us coming in here and type it, inflation here, we would rather use the indicators that we have set to identify our first line item. So we said our first line item should have an indicator of 1. So we will put it here. This is just for presentation purposes. So it's not every time, it's not cast in stone, but just for presentation purposes, this is where we are putting it. We put it here, and we are going to use this 1 to come in here and get the name of that item. So if I come in here and decide that inflation is no longer number 1, but I want 1 to be something like 5 and 1, if I can just put 1 here, and automatically my calculations change. I think it will be better if we are done building this, and then I'll show exactly how that works. So we have to bring in our 1 here, and then we are going to use that 1 to get in whichever name that this 1 is associated with. So I think at this stage is the stage I probably use the most advanced Excel formula that you're going to use in this model. Probably the most advanced issue is index match. Now, index match is a type of lookup formula. So what we are doing here is that we are using 1 to look up the value, its associated value. So we are using index match. This is more of a lookup formula. Now, the idea behind index match is that you provide whichever location, the general location of the item that you are looking for, and then you provide the position of that particular item, and you get the item that is there. So the position of the item is fixed. So whatever you put at that particular position is what you get. So we're going to start. I'm not really going to explain the syntax very well because of time, but just to give you the general idea that when you start with index, the first thing that you want to give index is the item that you want. Where is it located? So if we come to our assumptions page, we realize that inflation is in the column B. So we can just highlight the entire column B to show Excel that the item that I'm looking for will definitely be in this column. Now, the next thing that you want to talk about is the position. So if you've shown Excel that the item that you are looking for is in this column, where is it located? Of course, we can see that it's located in row 27. But we don't want to come in here and manually input row 27 again for flexibility purposes. So what we will do is, because if I change number 1 here and put it here, it's no longer, my first item is no longer in row 27. So if I come in here and put in the position directly, it gets fixed there. So the first thing that I will do, the first thing that in doing your position you will need is that kind of key that you would use to identify whichever value that you are working for. So our key is number 1, which can be found here in our scenarios page. So we come in here and we pick that number 1. And with this key that we are using to look out for our value, we also need to show Excel where this key is located. So we go back to our assumptions page, and this key is located here in this column E. So we select that column E, and we tell them that we want an exact match. So where you see exactly 1, that is exactly what we want. And we close up, and we should have inflation here. So if I decide that here should no longer be inflation, I change the value to 2, it should automatically give us whichever value that 2 is attached to, which is sales prices. It's the same idea that if I decide that inflation should no longer be 1, and that probably this should be 1, and I put 1 here, it should automatically give us, and I put the 1 back here, it should automatically give us whatever 1 is associated with. So this makes your model more flexible and makes you able to basically change your assumptions as you would want without having to manually come in and recalculate anything. So that's the whole idea behind using a lookup function to find information instead of manually typing in. Okay, so here we basically have the item that we are looking for, and usually we will set a header for it. If you can see the example from here, the header says the scenario and then the scenario name. So we will do a formula. Because we are typing actual text, we put it in quotation marks and says scenario, and whatever number that is here will be a scenario number. And so the ampersand is just to help us connect text to cell references. And basically it says that scenario 1 is inflation. Put some space after that. So scenario 1 is inflation, and we have our header. So after setting your scenario, the name of your scenario and the item that you are selecting for, you might want to get the kind of scenario cases that you are building. And usually you build for a base case, a best case, and then a worst case scenario. We also have them under assumptions. So usually we would have just come into our assumptions and probably copied them. Base, best, worst case scenario. Okay, so the best case scenario is your average case scenario, is that scenario that you probably do if you are being modest. So you don't want to over project, you don't want to under project. You just want to be a bit modest with your projections. Then you use the base case scenario, and that is the scenario that we put in our assumptions page. So every figure here that we have in our assumptions page, all these hard-coded figures here, those are our base case scenarios, or our base case assumptions in this case. And after the base case, we have the best case. This is the best case where conditions are probably better for you. So something like inflation, which increases your cost. If your inflation is lower, it's a good thing. So that will come under a best case scenario. Then the next one is the worst case scenario, where things are not so good based on your initial assumptions. So probably in this case for inflation, if inflation is high, it means your costs are higher. So that is not a good thing. So a higher inflation would represent a worst case scenario. So the first thing that you will do is to bring in your base case scenario values, which you already have in your assumptions. And then based on these base case scenario values, you are able to project your best and worst. So the same idea that we didn't type in inflation directly is the same reason that we wouldn't go and get these figures that we have for inflation. Where are they? The same reason why we wouldn't go get for these figures that we have for inflation directly, but we would rather use a lookup function to make it more dynamic and flexible. So we select, these assumptions are for our forecast years. So we have to make sure that our forecast years are selected. I think have to make sure that our forecast years are selected. And then what we do is, let me try and fix this. Yes, I mean. Okay. So I was trying to fix this to the window so that everything shows up well. Okay. So the first thing, like I said, the same reason why we don't type in our inflation value directly is the same reason why we wouldn't want to go there and get the figures. So that if we change our scenario, it's automatically, the figures also automatically change to reflect that. And also we are building this model for a future date. So all these assumptions are related to the forecast period. So we use the same lookup function, which is index, and then we go to our assumptions and then direct Excel to wherever we want to get our figures from. So in this case, our forecast period starts from L. So we select L, and then we show the position of whatever value that we want with match. So the same way, we go to our scenarios page and pick up the key that we are using, which is the one that we have here. And we are going to, because we are going to copy this formula to the right, we want to put this value in place. Cell reference in Excel means that as you move to the right, this highlighted blue cell also moves to the right along with that and picks whichever value that is there. But we always want to have this one picked. So we lock it in place. Okay, and then we go back and tell them where this one is located, which array this one is located in, and we already identify that it's located here. And same reason, we don't want this to move, so we lock it in place. And then we want an exact match, so we do this, and we have our inflation values. If you come back here, the inflation values are here. If we change our assumption, we should have sales price values. Now these are because the cell has been formatted as a percentage. That's why you're seeing this as a percentage. But these are basically the same sales price values that we have down here, the 800. So that's what us using these lookup functions do. Okay, so now we have our base case scenario, and you can see that because this is from another worksheet, we have this formatted as green. So from this base case scenario, we can then decide that for a best case scenario, we've identified that for something like inflation, which increases our cost, for a best case scenario, we expect inflation to reduce, but then how do you expect inflation to reduce by? And this would depend on you the information that you have as an analyst, your knowledge of the industry, and your knowledge of the economy to know that if inflation should reduce, at least it should reduce by this. So usually conventionally, we just use 10%, but this is just for the case that we are building and usually what we do, but it depends on whatever case that you are working on. So context matters a lot. So we are going to say that inflation should reduce by 10% for a best case scenario. So we put a negative 10% here for a best case scenario. And for a worst case scenario, we would say that inflation should increase by 10%. So we just come in here and we want to increase this by 10%. So we multiply this by 1 plus, we want to reduce it by 10% plus this. So although we are adding, because we already have the negative here, that's the reduction. And we put this in place so that for subsequent years, it's still this value that is formatted. So we have 1.8% to 2.3% for a best case scenario. And then for a worst case scenario, we would expect that same base case scenario to have increased by 10%. Okay, 1 plus. So now we have 2.2%. So in the year 2018, inflation could be as low as 1.8% or as high as 2.2%, based on the scenario that we are working with. So the reason, there's one major thing that we use, which was cell reference. I won't go much on it, but usually for a model, we structure it such that we want to make sure that everything has a consistent structure. So we've been able to build for inflation based on the choice of formulas that we used. Should be easier for us to build for sales price and volume growth without having to go through this whole process again. But there's one more thing before I show you how that would work. There's one more thing. Now that you have these three scenarios shown, at any point in time in your model, so if you come in here to your summary page, at any point in time in your model, you realize there's just one of them that is working. So you have to make sure that although you've calculated all these, you have to make sure that at any point in time, it's only one of them that is selected. So how do you make sure that which one is selected? Scenario selected. And of course, we have to tell Excel what kind of units that you are dealing with. So these values are year-on-year inflation figures, so percentage per annum. So as scenario selected, we want to make sure that if someone goes to the summary page and says that they want to view base case, for example, then our scenarios should represent these values for the base case. If they come in here and they say that they want to view best, our scenarios should show values for best. So we need to find a way to show these based on whatever someone has selected. So if we come in here, and we already mentioned that index helps us to look up values or to locate values based on their position. So if we come in here and we can say equal to index, and then we select these three. Now we realize that for base, we use a value of 1. We use an indicator of 1 for base. That is different from this one that we have here. We use an indicator of 1 for base, 2 for best, and 3 for worst. So if you want to show a particular value for base, that means that when within this group of cells that you selected, you need to tell index to bring 1. So if you say 1 here, index will be showing the base case scenario. But we don't want to come in here and if someone comes here and select best, which has a key of 2, an index of 2 here in our assumptions page, from our assumptions page, best has an index of 2. Now, if someone comes here and select best, you don't want to now come to your scenarios and come and change the formula and put 2 there. So what we do is to go to our assumptions page and link it with the scenario index that we have built in our assumptions page. We've already named it scenario index. That's why it has picked up its name. So let's copy this to the right. So at the moment, the scenario that we selected is the best case scenario. So you realize that it's showing the best case values. If you go to our summary page and select the worst case scenario, it should show the worst case values. But one more thing, how did we make sure that whatever that we are calculating here as worst best, it's actually affecting the summary values that we have here? So one thing that you should know is that these summary values are based on whatever values that we have as our financials, which are also based on whatever values that we have as our schedules, where we make our calculations. So after creating these scenarios, they don't just sit on the scenarios page. You actually have to connect them to your calculations. Otherwise, they are useless. They're just sitting here. So you connect them to your calculations page. And I think we named these cells. So we named this range of cells as our scenario 1. So when we come to our financials, our calculations page, this is our schedules. I think that comes before your financials. So when it comes to our calculations and you are calculating for price, we have inflation here. And the inflation value is supposed to, would have probably used the values from assumptions. You would have probably used the values for assumptions. But when you come in here, instead of going to use the values from assumptions, you want to make sure that it depends on whatever value that you have selected here. So instead of going to pick the value from the assumptions as you would have done for the others, you will come in here and then enter the name of the scenario. So scenario 1, we know scenario 1 is for inflation. So we know scenario 1 is for inflation. So we named it, we call scenario 1, and we have our inflation value. So it's the same for sales prices, where we link it to our scenarios. So now when someone goes to the summary and changes, this is how it works. So if you change base, first, whatever scenario here changes to base, and then the calculations that you have here also changes to reflect the base case calculations. So that will then come in here and feed the financials, which feeds your summary page. So that really is how this works and how this kind of connection that we have here works. I hope that was helpful. So it's the same idea that we did for inflation is how we do for sales price and volume growth. That is it. I think I can end it here.
Fantastic, Priscilla. That is just to demo how to do the scenarios page, how to create a scenarios page. So in summary, what Priscilla did is that for the lines that we think would impact our model, example, inflation, sales prices, and volume, we don't want to go in with one thinking. We want to create base, best, and worst for these indicators. Okay, so that when we are calculating, we have 3 options to flex our model with. And that is what she demoed. So after doing this calculation, you now use these lines to create your schedules. I saw a hand up earlier from Evans. Evans, please come back if your question is not answered and ask your question. If there are any other questions, too, please feel free, raise your hand and we will let you talk. Are there any questions, please? Okay, so we are gradually building this model, and what we are now going to do is, so earlier we set out our layout, we went through how to do our assumptions, okay, and then we just finished the scenarios page, which gives us options to flex our model, base, best, and worst case. Now, the next thing is to go to the schedules. And you remember when we started, we said the schedule represents the calculations for your financials. Okay, so again, the schedules are also arranged in the same way that your assumptions are laid out. So you realize that in the assumptions, after we do the settings, we jump straight to revenue, and then we go to operating cost in that order. It is the same layout that we are going to use in calculating each schedule step by step. So if you're going by this layout, then it means the first schedule we are going to build is to forecast revenue. Okay. And let's go back to the question and then see what they require of us in projecting the revenue. In 2017, which was the last financial year, net revenue was this, okay, 594.44 per unit, representing gross revenue of 6944 per unit, less freight and warehousing costs, depending on the industry they are in. They indicate that this is a cyclical industry and the sales prices are expected to average 800. That. So based on all these, we need to take these notes and then project our revenue for 18, 19, 20, and so on. So that is what you should have in mind when you transition to calculating your schedules. That's your revenue specifically. So I'd like to invite Dewinga to walk us through the logic and the typical things we do when we are modeling or projecting our most important line, which is revenue. So D, if you are ready.
All right, Ben, thank you. Let me share my screen.
Okay.
Okay, kindly confirm you can see my screen.
Yes, we can.
All right. So the revenue schedule is quite very important. Whether you are building for AFM or a real life model. Now, typically you can have more than one revenue line, but let's see in our case how many we have. When I say more than one revenue line, let's take a company like Apple. Apple, they have phones, they have tablets, iPads, they have iPods, they have MacBooks that they sell. So for each of these lines, you want to know how many MacBooks they will sell in this year, and then how many AirPods they will sell in this year, and so on and so forth. So it's important to understand how they make money. That's the key thing. And in the revenue schedule, you want to drill down to the very basic level, the unit price, and then the unit sales. And so you now understand how they make money and you know what forecast to make. Now, in this case, we are told that in 2017, they had a net revenue of 594, which is a gross revenue of this, less the freight and warehousing costs. Okay. Now, we have already structured this model. So let's just go according to the structure because this is more like a demo. So we have here the gross revenue. So we are told that the gross revenue is 694 per unit, right? Dollars per unit. So in 2017, yeah, have so this already is laid down in my assumptions. I think this is done in the assumptions. Yeah, so you have it here. So it's already laid down. So I'll just link this to my assumptions and say the gross revenue in the last actual year was this. And then the freight and warehouse costs, same thing. I'll copy down this $100 here. Now let's look at the assumption. They're saying that this is a cyclical industry and the sales prices are expected to average from 800 in 2018 all the way to 750 in 2022. Now, remember we have that already captured in our assumptions here. And then we assume that this will have a significant impact on the model. And so in our scenarios, which Priscilla just demonstrated, we flex that line over here to simulate all the three scenarios, the base, best, and worst case. And so in my schedule, what I'm going to do for my sales prices, instead of keeping this flat, I'll call on the active scenario. So if we are running in this case base, I want to see the base case prices here. So what I can do is to highlight the forecast year period and then call on that sales prices and then the active scenario. Now, in my scenarios, I think that was the second scenario, scenario 2. So I would say scenario 2 like this, colon scenario 2, and then I have these prices here. So if I show you by changing, so here you're seeing 800 and 750 in our last forecast year. Now, if I change this from base case, for example, to a best case, then I can see that this has changed from 750 to 825. Cool. The next assumption here is that the freight and warehousing costs are expected to increase at inflation. So let's see. This cost here, this $100 in our last actual year, over the forecast years is supposed to increase at inflation. And so I need to call on my inflation, which I will now use as a growth rate to grow these costs. So let me call my inflation for the forecast period and say, that's also a scenario. And I think it's the first scenario that we had. So I'll say scenario 1, and then I have this. So I'll now grow my $100 by this rate in each year. So if I take the previous years, I'll say times 1 plus the growth rate in that year, the inflation that year, then this. Next is the factory has a capacity of 420K units per year. So it's just like the example I gave you with Apple. Apple, they don't have unlimited resources. So maybe they can only produce 1 million MacBooks in a year. And so that's the capacity constraint. So we are given a capacity constraint of the factory here. So I think we have that in our assumptions. So I'll just go to my assumptions and fetch that figure over here, 420. It's been truncated by 6 zeros. By 6 zeros. So this is going to be the capacity constraint. Now let's see how our capacity grows. Sales are expected to grow at this rate. And that I think is our last scenario here, sales growth. So again, when I come to my schedule, I'm going to look for the sales growth, and then I'll grow my volumes by that growth rate. So for my forecast here, I'll call on the last scenario like this. Now, I think the basic thing or the key thing you have to understand is, like I said earlier on, you need to drill down to the very basic level. How do they make money? These guys, they make money by selling a number of units, right? And so we need to know how many units are sold each year at what price to determine the revenue they make. Now, the trick here is that we know how much sales they made in the last actual year. And so that should be enough indication. And given that we know as well the revenue, the gross revenue per unit they made, we can now tell how many units were sold in that year. So first of all, to know how many units were sold in the last year, we can fetch our gross sales or gross revenues for the actual years. So that is in our financials. So I'll say here, gross revenue. In my financials, they are here. Here. My gross revenue and then the freight and warehousing costs like this. Now, if they made these sales in 2017, 239,000, and then each unit is sold at this price, it means that when I divide the total sales, remember here we are told that it's gross revenue per unit. So essentially is your sales per unit, which is the same as the price, okay? So if I divide my total sales by the unit price, then I'll have the number of units that are sold in that year. And now once I have that, the number of units that are sold in this year, I can then grow this by what? The sales volume growth rate. Essentially, that's what I'm trying to get here. So over here, if I take the sales, the total sales in this year, divided by this gross revenue per unit, I'll be having something like this. Now, remember that these numbers we have here, they are truncated. When you look at the actual financials, these values here you have, they are in millions. So this you see here has been truncated. And in this model, we have so we have a scale here, a number converter of 1,000, and we named it K. So what I'm going to do is that this, I'll just multiply this by the conversion, the scale. Okay, and then I have this. So what it means is that in 2017, they sold this number of units at a unit price of this, of 694. And so when you multiply these two, you should get this total sales that they made in this year. Now that I have my volume, I can grow this volume the same way I grew my price up here. This cost over here. So I can do this, put it here, and then I have this. So, I mean, what I'm doing here is not really teaching, but like Bernard said, there are a lot of shortcuts or a lot of things that as a modeler you do, like copying and pasting formulas and stuff like that. So we have now our factory, sorry, the sales. But if you realize, we are told that there's a constraint to the capacity, that the company cannot produce over 420,000 units. But if you see in our final year here, we have 431, which means that this is not a true reflection of the reality. So I need to put a hard stop and say, once we hit this threshold, we cannot produce in excess of that. So I would say here I can just put a minimum of this and then so if I do this, you now see that previously we had 400 and over 420 here. I think we have 431. Now with this, it means that once we hit that threshold, I have a hard stop at 420. So I have the two things that I need to tell how much total sales were made each year. The volume, which is the number of units that were sold, and then the unit price at which each of these units were sold. So I can now go back to project my revenue for each of these forecast years. Essentially, I'm going to say that my gross revenue or sales is the price, which is this, times the volume, which is the number of units sold, and then I have this. Now, you can see that this is giving me the values without the truncation. So I just have to bring in my scale and divide this by K, and then I have this. So essentially, this is a forecast sales for Henderson. And then for the freight and warehousing cost is the same thing. We know the units cost here times the volume, the number of units that were sold, divided by K. And then you have this. Now we can now find our net revenue, which is knocking off the freight and warehousing cost from the gross revenue. So if I do this and say this minus this, then I have this. So essentially, this is how I will determine my my gross revenue, total sales, and broken down into this component. If I change this back to this case.
Okay. So I think that was brilliant. The idea is to actually use the logic in the question and then translate it into Excel formulas. And if you've been following us, what we've been trying to do is to use the notes or the assumptions to model each segment. And what he just did is just to model the revenue section based on the notes that have been given. So in order not to go beyond the time, by now you get the idea that we are in the schedules and we are calculating segment by segment. So when we come to operating costs, it's the same thinking. Whatever notes they gave us, we take it, we calculate, and then the output, we keep it in summary here on standby for our financials. Okay, so operating costs will be calculated like that. And then we go to long-term assets. So long-term assets is a very sensitive part of the model because in here, you have the calculation of your depreciation. Okay, there's this nice layout, we call it the waterfall approach to depreciation. And I'd like to invite Ferdinand to quickly walk us through how to calculate this in a schedule. Hi, Ferdy, are you there?
Hi, Bernard. I am here. Can you see my screen, please?
Yes, we can.
Okay. All right, so let me quickly delete this and let's build it together. Okay. So basically, as I said earlier, the structures really matters, the layout. So typically, I'm going to reconstruct the depreciation here. And before I do that, in here where we have our inputs, here you can see that we have some dates here, some years, sorry, here. So these years represent the years of purchase, all right? And at the top here, we have, our actual and forecast, periods. So we are going to use the years also here to also do the calculation here. But I want you to have in mind that this one represents the years of purchase, okay? And here, we are actually going to project for our CAPEX, okay, for our CAPEX. So what I'm going to do is that I'm going to bring my CAPEX here, okay, to allow me to make an easy calculation. So I come here and I do transpose, okay, and I call these figures and have them here. So as I said, again, layout. So I needed these numbers, to be here, all right, for my CAPEX calculation so that it will be easier for me to do the calculation. So here, and now I'm just going to write just one formula and copy it across. So what I'm going to do is to highlight the entire range and type in just one formula and do the magic here. So here, the formula that I'm going to write, very simple. Here we have one assumption that we always pick when we are modeling, the CAPEX for the depreciation side. So most of the time, we normally assume that in the year of purchase, okay, we do have here depreciation. So here we are just going to ask ourselves, is this where I'm currently standing, okay, in this column, which is column L, what's the year here? So here, this year, locking this, all right, is it equal to the year of purchase? So if it's equal to the year of purchase, that means that that's where I've purchased and I need to give it a half depreciation. So this is how the formula reads. So if it's equal to the year of purchase, so half depreciation. So my CAPEX, which is here, all right, just look what I'm supposed to look. So divided by, the useful years that I have here. Okay, and because we need what? We need, half depreciation, so I divide it by 2. So in the year of purchase, we have half depreciation. So later, I now bring in to find out in which year am I in. If I'm in the following year, all right, I need a full depreciation. So I'm going to check for the year. So if I'm currently in this, okay, if I'm currently here, and is if the year of forecast, all right, is greater than the year of purchase. So I need a full depreciation. So I'm going to take my CapEx here and divide it by my useful years for the CapEx. So if that is done, what do I need next? For any other thing before, that means that it should be 0. So I type in a 0 here, and this is how my formula look like. So with just one formula, I'm able to determine exactly how my depreciation should go. So just to quickly run through, the first question I ask myself is my year of forecast equal to my year of purchase? If it is, that means that I need to have depreciation. So if not, I now check again if my year of forecast is greater than my year of purchase. So that means that I'm moving to the next year. So if I'm moving to the next year, the depreciation should now be a full depreciation. If not, any other thing should be 0. So I have this written, and I just do Control Enter, and I have this. And this is what Bernard said, the waterfall, calculation for our depreciation. And as you can see, we have already tied in, the calculation here. So I come here to just, just sum up my depreciation for my CapEx and quickly. And I come here to do my total depreciation, which consists of this depreciation that we've already calculated earlier. This is just straightforward. So it's just, taking the existing and dividing by the useful life. All right. So here we are using just a straight line. So here, this is just the summation of my two depreciation, which is the existing and the depreciation for my CapEx. So I have this, and these are back into our fixed asset calculation here for the depreciation line that we have just here. So typically in the model, this is how we do the depreciation calculation.
Fantastic, Ferdinand. So again, if you just joined us, we are just on a journey. We started with an understanding of what financial modeling is all about. And maybe you're just joining and you don't know the guys who are on your screen. So we are from Finance Skills Hub. It's a training firm. We teach financial modeling, Microsoft Excel, and then analytics with Power BI. We've been doing this for over 6 years now, and we've trained over 30 advanced financial modelers. It's not only financial modeling, but Excel as well. So my name is Bernard Obin Boateng. I also have Ernest Abuaje, who is also here with us, a financial modeler. Ferdinand is here, the winger, and Priscilla. So just to recap, we've just gone through the typical financial modeling insights, and we are just demoing a simple case study. Okay, the goal is not to force this on you in just this short space, but to get the general understanding of how we approach a typical financial model. We'd like to hear from you before we continue. If you have any feedback, any questions, please feel free and let us discuss this. Are there any questions, please? Evans, I saw your hand up earlier. I don't know whether that was an error too. Okay. So we are in the schedules. The schedules I mentioned are calculations. So here, this is the heart of the model. In fact, whatever you do here, you will output it on standby to put it in your financials. Okay, so in the end, everything that you've done in the schedules is going to be swept here. And then if you did it well, it will reward you with a balanced model. If you didn't do it well, then you have to go back and check your calculations. So because of time, Ferdinand just showed us the depreciation. And then one other aspect is taxation and working capital. So I'll invite Mr. Abuaje to quickly, maybe in 5 minutes, walk us through the key insights for taxation and what we are supposed to take note when we are modeling taxation and also working capital. And then when he's done, we'll just go through the sweeping into the financials and then we'll discuss our summary. And if you have any questions, you can please let us know.
Thank you, Ben.
Okay.
And thanks, team. So quickly, I will share my screen and then we'll run through the tax. Okay, please let me know when you see my screen.
Yes, we can.
Okay, great. So the tax is a major aspect of our projections. And as we know, we project tax off the earnings before interest and tax. So I will quickly delete everything here, right? And run through that with you. It's not going to take us a lot of time. So let me just do that. And then we go. All right, so do I really need to keep the greens? Yes, it's fine. I'll leave the labels here, okay? And then the tax rate here. So in simple terms, this is where our final calculations will rest, okay? So we need to calculate the rest, the timing difference and everything that we have been doing. Our earnings before interest and tax has been given in, has been done already, right, in our financials. So let's just go and pick the EBT. All right, so this is the EBT, earnings before interest and tax, right? So before tax, sorry. So we pick this EBT. And then what we are going to do is that we need to adjust by timing difference. And timing difference is about the difference between some expenditure that we used, which are not allowed by the tax authorities, right? In this case, they are rising as a result of the temporary timing difference. And as we all know, which I believe we do, the timing difference here was given to us, so it's straightforward in the case study. So if we will pick that, we realize that in the case study, the timing difference was given. All right, so if you read this part, it says the tax rate is 35%, which we have captured here, right? And then it says the aggregation reduction in government pre-tax earnings due to temporary or due to timing difference between accounting and government rules is expected to be 5 million per year for the next 5 years. And they are saying 5 million here reduction. So these key words are very instructive. It means that we need to reduce our EBT by 5 million across. And we have fully captured this in our assumptions. So if you look at our assumptions here on the tax bit, you can see that we have our tax rate and then the timing difference, 5 million negative or reduction captured for the forecast years. All right, so what we're going to do is that in our shadows, we need to go and bring our timing differences here to adjust. So quickly, our assumptions are here. Okay, so we link to this. All right, so what is going to happen now is that we are going to adjust the EBT, reduce every year's earnings before tax by 5 million to get the actual tax that the government is going to consider. So it's going to be this plus that. I'm going to add it because this is already negative, right? If not, I would have done this minus that, right? So that we get the adjusted. So now this is what we calculated as our EBT from our financials, right here. What the government is saying is that, okay, for whatever reason, some expenditure, so a classic example would be depreciation, right? The difference between depreciation and capital allowance and all those things, those of us in practice, we know that our tax calculation will not necessarily be the same as that which the government will use. So the government will also recompute their earnings before tax and slash the tax. So in that case, it has been simplified as a timing difference between our earnings before tax and the government's EBT. So what's going to happen is that we will calculate our tax that we thought, was. So that will be our EBT times the tax rate that we have, okay? So that is this one. And then go ahead and calculate the government's tax. Now the government is saying you brought 46 million or whatever, but I expect you to be paying tax on 41 million, which is good news, right? I mean, at least for the moment. So what is going to happen is that we'll calculate what the government expects from us in terms of taxes, right? So we thought we were going to pay in 2018, 16 million, but the government is saying for whatever recomputation they did, perhaps they allowed more capital allowance in the early years than we charged in depreciation, right? So what it meant was that their EBT went down and our EBT was slightly up because we charged a lower depreciation as against the capital allowance granted. Right, so the difference between the accounting tax and the government tax that we showed is our deferred tax. Okay, it's our deferred tax. All right, now what is going to happen is that once we have calculated what we thought we were going to pay, but this is what the government is saying we should pay, then what it means is that for such a temporary timing difference, we are generating deferred tax liabilities, which will settle somewhere in future, right? So let us now bring in our taxes. So the current tax we have here is the government tax. Don't forget that. The current tax we are showing in our financials is what the government is saying we should pay, which is this, right? It's here. Then the deferred tax we have calculated already. So let us link to that, which is here. Then our total tax, did I really link well? Let me just link properly. Okay. Then our total tax will be a sum of this. All right. So we have our total tax being a sum of this, what the government is saying we should pay. Let's leave it in one decimal place, which I think is fine. And the deferred taxes we are generating. All right. Now what's going to happen is that we have a deferred tax control account, okay, which is coming from the balance sheet. We are linking the taxes to the income statement, and then we are the tax charges, right, to the income statement, then the balances to the balance sheet. Quickly, I have highlighted those areas so you know. Let me just delete them, at least, for the purpose. So this is where our current tax will go, and this is where our deferred tax will go. But because I've calculated them and linked them already, we can now go and link to them here because these are current tax, these are deferred tax. Okay, then it pulls through. When we come to the cash flow statement, we need to adjust the cash flow from operations with our deferred tax because we know that our deferred tax is not a cash flow item. It is not a flow of cash. It's actually what we call a notional charge, right? Just for timing differences. So in the future, it will revert when the liability overturns itself to an asset and it nullifies. I believe you understand all of this. That's why I'm kind of moving faster at this part. All right, so let's just adjust for the deferred taxes. So we'll link that here, and then we have that. We will have to put this in the balance sheet, right? Over the years, we have been generating some deferred tax liabilities, and even for the forecast periods, per our assumption of the government giving us some timing differences of that, we are still going to continue enjoying some tax liabilities until, I mean, not enjoying this, but we are not going to pay upfront until later when it overturns, and then we pay off. All right. So let's link this to the closing balances of the deferred tax account, which we have in the financials. So that is here. Okay, and because they are linked from other sheets, that's why you have it as green. Well, you may even well want to color these ones as green. Okay, if you want to. Okay, we don't have, okay, what is B? And we don't need a borderline in there. We need a borderline here. It's fine. No, what is BP? We need a borderline there. Yeah, it's fine. So closing tax for the prior period becomes the opening balance for this. So we have this here. And the deferred tax, movement which we have for the period is going to be the deferred tax we have calculated. So we will link that to this. Okay. And then the closing balance will be a sum of these two. Okay, it looks like my spreadsheet is dancing, but all that I'm doing is addition. I'm summing them. I'm not doing anything special. Right. As a modeler, you must learn to use the shortcut keys rather than your mouse so that you work very fast. So let's fill this to the right, and then we have our deferred tax calculations for the forecast years. All right, moving to link them back here into our balance sheet, into the yellow spot, then we link them as such. Okay, so we have it here. We link to the closing balance, and then we have our deferred taxes here loaded. Any question on deferred tax before I move on?
I don't think we have any questions. And I guess at this point, we can fairly sweep to the financials. And then,
okay.
Yes, and then maybe round up.
Sure.
Yeah.
Thank you, Ben.
Sure. Mr. Awaji, thank you very much. So that was on the deferred tax and how to calculate that. To be fair, these calculations we are doing, we do them over time. We practice over time before we get to this stage. Students typically go through some Saturdays of training. And we've also had cases where somebody walks in even without an Excel installation, and you are still able to get to this stage. In fact, all of us started from somewhere. And going back to the earlier question, you don't really need to be an Excel black belt to be able to do financial modeling. In fact, of the list you have here, there are 2 chartered accountants, but the rest of us are not chartered accountants. So just to give you an idea and to inspire you that it is possible, financial modeling has become a skill that will be in demand for a very long time. And I feel that in this space, it will be very good if you have it as part of the skills in the box. And you are even able to use it for budgets and all those things that require planning or you use for decision making. So in the end, what we've effectively done is we started from an assumption. We've created our scenarios. We built our schedules, and because of time, we just wanted you to show you some of the key tricks that we use in calculation of these areas. When you are done, and you have done all the calculations well, the final step is to sweep all your calculations into your financials. Okay, to sweep all the calculations into your financials. So in the end, it is this part, the forecast, that you've just done in the schedules. And then you now link all the calculations into this space. Okay, step by step. And then when you are done, you go back and calculate your last balancing item, which is your cash, which you generate from what we call the revolver calculation. You see, in essence, a business thrives on cash. If a business goes into deficit, there has to be a mechanism to restore cash, either through an overdraft or loan. And it is that concept that we build into our revolver. Okay, so when you calculate the revolver, that line comes in to now balance your model. And then finally, when you put in everything, as a good modeler, this is your final line. You should now balance your model. And now based on these financials, you can now create a summary page to inform your clients on what to do and what not to do. Truth is, this probably is a very simplistic approach, but it is just to give you an idea of one, what financial modeling is, two, the skills that you require, three, how to approach it typically, and then also to introduce you to the fact that there are certifications available. If you want to gain global certification in this, we are aligned with the Financial Modeling Institute. You can go all the way to become a chartered financial modeler. And this is just after 2 exams, and you should be good. Okay.
Yeah, I want to graciously express our appreciation to the team that did the presentation. I must say that this presentation has been one of a kind. It's been very elaborate and deep and eye-opening to me especially. I've been doing financial modeling somehow in the wrong way and amateur way, and that I can actually say that I've been opened, or my eyes have been open. I want to believe that many of us too have found this presentation very beneficial. So we are very grateful to them for this opportunity done us. Going forward, I think that we should be able to link up with them to individually see how best we can grow our knowledge and our competence in this direction, so that we can be in a position to deliver financial modeling in a more professional way. So I would want to say that we are grateful, and I believe that our relationship going forward should be one that will be beneficial to both of us. Thank you very much, sir.
Welcome, Mr. Kakari, and we also appreciate the time spent with you. As mentioned, I see some familiar faces who have joined our trainings in the past. I see Achi, I see Joel. We actually have a good number of accountants within our community. So this is Finest Skills Hub. There's an upcoming training this June. We'll do financial modeling, analytics, and then Excel for work. Okay, so you can find more on our website, Finest Skills Hub, FINEX skillshub.com. When you go, you can join our upcoming training. So you can download our brochure and then read all about it. Okay. I've not done this alone. The team is a very solid team. We have Mr. Ernest Abuaje. He's a CA and a SIMA. We also have Osbert Kuhn, who couldn't join us. We also have Ferdinand Natobra. We have Dewinga Amenonka, and our lady in the team is Priscilla Ba. And we also have Daniel, who's also a chartered accountant. He couldn't also join us. But we are open to taking this relationship further, and we appreciate the time that you've spent with us as well. So on this note, I guess, if I have your permission, our new lady on the block is Na Ayoko. She was also in the audience, giving us eyes and feedback. So Na is our new baby on the block. So please, let's get in touch, and then let's take this relationship further. We appreciate the time as well. Thank you, Wisdom. Thank you, Mr. Kakari, for the time.